Surviving the storm. Strategies for making money in a crashing economy. Hey folks, welcome back to the channel. Today, we're diving into a topic that's on everyone's minds. Making money in a crashing economy. Yep, you heard it right. We're going to chat about some strategies that can help you navigate those turbulent financial waters. But before we get started, do me a favor and hit that subscribe button below so you never miss out on these money-making insights. All right, let's jump right in. 1. Cash is king during a recession. Now, you've probably heard the saying cash is king, but what does that really mean, especially when the economy's taking a nosedive? Well, according to Michelle Griffith, the wealth guru over at Citi Global Wealth, in times of economic downturns, it's better to have a little extra cash tucked away. You know, just in case the storm gets a bit too rough. But here's the deal. Selling off all your investments to hoard cash? Risky move. You might end up selling too soon and find yourself stuck with a pile of cash as the markets start bouncing back. Not ideal, right? So, what's the game plan? Michelle recommends shifting into investments that can weather the recession waves. Smart, huh? And hey, keeping a chunk of your portfolio in cash or easy-to-sell securities like a money market mutual fund is always a good call. It's like having a financial safety net. So, remember, cash is king, but don't go all in too soon. Balance is key. 2. Own defensive stocks in a recession. All right, let's talk stocks. You've got your cyclical stocks, those roller coaster rides that go up and down with the economy. But in a recession, you might want to cozy up to something a bit more stable. Enter defensive stocks. What are these mystical creatures? Well, they're the stocks in non-cyclical sectors, like utilities and consumer staples. According to the experts, these stocks tend to be less affected by the economic roller coaster. Think about it. People still need electricity, toilet paper, and their daily groceries, no matter how tough times get. So during a recession, consider shifting some of your investments to these defensive players. Utility stocks and consumer staples can act as your financial bodyguards, protecting your portfolio from the punches thrown by economic downturns. And here's a nugget of wisdom. Healthcare is another stable sector. According to a report from 2021, even when the economy is doing a little dance, healthcare employment seems to be on the rise. Makes sense, right? People still need medical services, recession or not. Now you might be wondering, what about those consumer discretionary stocks? Well, they're the high flyers when the economy is booming, but they can take a hit during a recession. So be strategic. Shift some focus to the defensive squad to keep your portfolio strong and resilient. 3. Use dollar cost averaging. Now, if you've been around the investing block, you might have heard about this gem dollar cost averaging. But what's it all about, especially in the midst of a recession? Well, my friends, it's a strategy where you consistently buy a fixed amount of an investment, regardless of its current price. Sounds pretty straightforward, right? Why is this golden during a recession? As the market takes a dip, you're snatching up shares at lower prices. It's like a sale on your favorite stocks. You can go about it in two ways. Either invest new money regularly, or set your dividends to automatically reinvest in the security. Both work like a charm. So when the market's doing its little dance, keep calm and dollar cost average. It's a steady, strategic move that can pay off big time in the long run. 4. Buy quality assets during a recession. All right, let's talk about shopping for stocks in a recession. No, we're not talking about the discount aisle. We're talking about quality assets. According to our financial guru, Katz, in times of economic turmoil, it's all about seeking out quality across different asset classes. What makes an investment top-notch during a recession? Low beta, high return on investments, and low leverage. These are the hallmarks of quality. Katz even calls these companies all-weather businesses. What does that mean? Well, they don't rely on economic growth to thrive or survive. They're like the superheroes of the stock market. Think about companies with high recurring revenue, like those with subscription-based sales models. These guys are less sensitive to economic downturns because, let's face it, people still need their subscriptions, even when the economy is on a roller coaster. But here's the kicker: steer clear of companies with heavy debt loads. Why? Because if the cash flow starts to dry up and revenues take a hit, those high debt companies could be in a bit of a pickle. Servicing debt becomes a struggle, and refinancing at maturity. Well, that could be a headache if lending standards tighten up. So when you're shopping for stocks during a recession, be a quality snob. Look for those gems that can weather the storm and come out on top. It's not about quantity, it's about quality. 5. Avoid growth stocks during a recession. Now let's talk about what not to do when the economy is taking a nosedive. Steer clear of growth stocks. Why, you ask? Well, according to the financial wizards, growth stocks, especially those tied to profitless companies with high growth prospects, tend to take a hit during recessions. Instead, shift your focus to more income-producing investments and dividend-paying stocks. It's like building a sturdy financial foundation that can weather the storm. 6. Invest in dividend stocks. Speaking of dividends, let's dive a bit deeper. The best dividend stocks aren't just about the cash flow, they're like a cushion for your portfolio during the stormy market weather. Even if a company's stock price decides to take a little dip, those dividends keep rolling in. According to Griffith, dividends are more than just extra cash in your pocket. They indicate strength. Plus, they offer a sweet method to dollar cost average during the wild market volatility. So don't underestimate the power of those dividend stocks when the market is playing tricks on you. 7. Consider actively managed funds. Now, for all you fund enthusiasts out there, here's a tip. Consider shifting into more actively managed funds during a recession. Research is showing that these funds tend to outperform their peers by a pretty impressive margin. We're talking 4.5% to 6.1% per year in down markets after adjusting for risk and expenses. Why is that? Well, active management means someone's keeping a close eye on the market, making strategic moves to protect your investments. So when the market is doing its recession dance, having an active manager in your corner might just be the winning move. 8. Bonds and uncorrelated assets. Let's talk about bonds, shall we? Bonds tend to be the unsung heroes during recessions. They can provide a steady ship in stormy seas, but here's the catch stick to investment-grade bonds to guard against rising defaults. Safety first, right? And now, for something a bit off the beaten path, uncorrelated assets. We suggest looking into asset classes like royalties, insurance-linked securities, and carbon credits. Why? Because when the traditional asset classes are feeling a bit weak, these uncorrelated assets might just shine. All right, savvy investors, that wraps up today's deep dive into making money in a crashing economy. I hope you found these strategies helpful and are ready to strengthen your financial game. If you enjoyed the video, don't forget to give it a thumbs up, hit that subscribe button, and ring the notification bell so you never miss out on our latest insights. Until next time, stay wise, stay invested, and I'll catch you in the next video. Happy investing.